Hey there, my name is Cole Oliver, a Senior Vice President with King Operating Corporation. I'm very excited to be partnering with Strategic Passive Investments in this unique offering in the oil and gas energy sector. Charles and Lena are both also excited about the departure into an alternative space like oil and gas. And I'll kind of not waste any time and dive right into this. So, why oil and gas and why now? That's some of the first questions that we always hear. If you look at the oil and gas industry from a consumption and demand perspective, the United States in 2021 used about 19 million barrels of oil per day and about 7.26 billion barrels of petroleum in a year. This was an increase in consumption of about 1.6 million barrels per day over 2020. And as we continue to add more people to this world, we have more technology that requires more energy to run. And we even have things like electronic vehicles being deployed, built, manufactured that require over 800 barrels of oil per battery. That demand continues to increase. We look at other major news headlines over the last few months, and we look at someone like JP Morgan's Jamie Dimon that says the US should pump more oil to avert war level energy crisis. Elon Musk says the world still needs to use oil and gas or civilization will crumble. And OPEC Plus cuts production by 2 million barrels per day to shore up prices, defying the pressure from the Biden administration, draining the strategic petroleum reserve, flooding the market with as much of the reserve as we possibly have, and ultimately leaving us with a deficit or a 40-year low in the SPR. When we look at the future opportunity, the SPR being at a 40-year low, an entity like OPEC Plus completely slashing production, domestic policy constraints from the current administration leading to a complete ban of drilling on federal land. Places like California, Utah, and Alaska completely shut off, along with most of the offshore drilling. And the final thing that we looked at that I mentioned briefly is the EV craze and the natural gas and oil that helps make it possible. So every single Tesla on the road has multiple batteries, all which required significant amount of oil just to make those batteries. Then every night when they go home to charge, they're relying on a power grid powered by natural gas. A state like California that recently said we're going to ban purchase of gas powered vehicles and it's going to be all electronic. This summer in 2022, sent out a text message to their citizens saying, please don't plug in your electronic vehicles tonight. We don't think the power grid can handle the consumption. So it's just that type of misinformation from the ESG side of the world and the current policy in place by the administration that is leading us to this very unique point in time where demand is continuing to increase. Some of the things that we think could be a threat to oil and gas actually require more of it, i.g., electronic vehicles. And then as we look at the overall supply that is available to us, it's being strangled by federal land restrictions, OPEC slashing production, and other aspects and other policies from the administration that tell us that if we can produce a lot of oil and gas, we can make a lot of money on it because there's not enough supply to satiate the demand that we see in the market. Jumping into our specific offering, a big part of this is the emphasis on the domestic aspect. We're drilling on privately held domestic land. We're selling to domestic companies and we're delivering energy for the United States of America. Now, the disclosure page, this will be provided to everyone. If you've had too many cups of coffee today, I strongly recommend reading this, and this will put you out fast enough. But definitely read through it, understand the risks associated with an offering like this, and past performance is not indicative of future results. Diving into the contents of today's presentation, we're going to look at strategy, we're going to look at the value for our investor partners, and we're going to look at the track record and team of the company. This is a $200 million raise. 100 million will be raised through financial arm of King Operating in partnership with entities like Strategic Passive Investments. It will also be raised through a broker dealer for the other 100 million, looking primarily at institutional funds from family office, pension funds, and other institutional bodies. Starting with strategy. Scale it and sell it for a multiple is the motto for our funds. It's a unique investment vehicle for accredited investors looking to reduce tax liability significantly, achieve monthly passive income, and a multiple on their capital at exits. This is the biggest differentiator of this oil and gas offering with anything you may have seen in the past or anything that you may be offered right now. Most oil and gas offerings do not include the assets, aka the leases and the rights to drill. So as they're developing out those fields, the companies are keeping the value from other aspects of those assets. In this offering, you are given your pro rata ownership of those assets, the leases, the rights to drill. As we develop them up, we create the opportunity for exits and divestitures. On the actual strategy of how do we scale it and sell it, it's a simple ADD methodology. We acquire awesome assets that have plenty of opportunity for drilling. We develop a portion of those, and then we put a for sale sign on it and sell it to a company, either a major or a mid-major, that wants to come in and continue drilling the rest of the asset based on the production that we've achieved so far and the third-party reserve report that has verified not only what we're producing today, but what that acreage position and that lease has remaining for another company to drill. Moving into the timeline, we've already acquired two incredible assets. Right now, we're in the midst of raising equity. To this point, we've only been accepting money for a little bit over a month and 1 week. We have $12 million in the door and over $30 million in commitments. As we start to drill at the end of December 2022, we will start producing revenue towards the end and beginning of Q1, Q2 of 2023. That's when monthly distributions will begin being delivered to our investor partners. As we prove the PUD locations, those are proven undeveloped assets, aka the remaining portion of those leases that we or another company that buys it from us will have the right to drill. We'll prove those at scale, verifying through a third-party reserve report, which will then open our divestiture window, the for sale sign on those assets, allowing other companies to come in, see the value, see the ease that they can deploy capital to drill the remaining assets, and that's what makes it a perfect fit. Aside from another company wanting to buy just for the sake of developing out the field further, there's also the possibility that someone will be interested in a non-operating ownership position where they just want to buy the revenue while the fields are continued to be developed out. That is what we would call the initial divestiture. That would allow us to return capital to our investor partners much faster than if we waited for the entire lifetime of the fund and just had one big exit at the end. We'll dive a little bit more into that concept when we get to the divest portion of our strategy. Looking first at our acquisition methodology, we start simply by sourcing deals in basins of focus or basins of interest. We look for areas where we have personal experience. We look for areas with a lot of comps in the area of already proven producing adjacent acreage positions. We want to find analogous production to make sure that this is an area that is known for producing the type of hydrocarbons that we're after, namely oil and natural gas. We're looking for a minimum of 20 drillable locations in any acreage position that we look at. It has to be in an oil and gas friendly community and regulatory environment. Got to be privately owned or state owned acreage, nothing federal. And we're looking for low cost, high control leasing terms, which allows us to negotiate the best rates that generate the highest returns for our investor partners. And finally, my favorite part of this from a de-risking aspect, we're looking for a strict product mix that is down the middle, 50% exposure to oil and 50% exposure to natural gas. It not only mitigates our risk, but it drives value by giving us exposure to two different products that both are experiencing a asynchronization between supply and demand that we can capitalize on to drive more returns and more value for our investors. On to development. This is where it gets pretty simple. We don't acquire any asset without having 3D seismic data already completed and interpreted to ensure that we know the oil and natural gas are there, hydrocarbons are present. Now it's just up to us to deliver a good well and execute on that drillable plan. So as we look at the timeline, we mentioned drilling the first 1 to 3 wells in December, completing those first 3 wells in January, and then beginning a larger drilling program in February of 2023, and also the possible acquisition of a third asset. As we look at divestiture, I mentioned that there is a difference between our divestiture and the exit. So that is where we get this idea of the sum of the parts is greater than the whole. By targeting an initial divestiture somewhere around that 18 to 24-month window, we're able to sell a portion of the fund, somewhere between 15 to 30%, to deliver the remaining principal back to our investor partners, possibly ROI at that point. But certainly our focus is to return principal as quickly as possible. That allows us to focus on developing out the rest of the asset and also putting the for sale sign on the larger portions of the fund, driving that final ROI for our investor partners. And that's really where the beauty of that model of having initial divestitures and then leading to an exit at the end allows us to accelerate the value, return principal, and focus on driving the final exit as quickly as possible. Onto value. The assets that we've acquired so far to this point provide us with a fair market valuation of a little over $1 billion. Every number that you see in here for the forecasts and forward-looking statements are based on a price point of $80 WTI oil and $6 natural gas. The current assets that we've acquired so far are going to be in the Permian Basin, up to 11,000 acres, and the Bighorn Basin, up to 25,000 acres. I mentioned having that product split of 50% oil and 50% natural gas. The Permian Basin is going to be an oil-heavy play, while the Bighorn Basin is going to be a natural gas-heavy play, providing us with that perfect mix. The beauty of the remaining assets that we're looking at are strong in a variety of both oil and natural gas, and will provide us the ability to continue that split. Of the locations that we've acquired, the Permian and the Bighorn Basin assets, those have 200 plus pre-qualified drillable locations. There are 18 shovel-ready, drill-ready locations where geology and engineering planning has already been completed. We just have to get the money in, apply for a permit, and be drilling as quickly as possible. 2023, our PDP, the proven developed producing count target, is 18 to 21 wells, and the 2023 PUD, proven undeveloped, the remaining amount of those assets that we can put the for sale sign on would be about 40 proven by the end of 2023. When we look at the specific economics and the forecast for the valuation baseline of those two assets, the Borden County in Permian, the Believers project, we will plan to drill 8 wells. Those will generate roughly 595,000 barrels per well for a total PDP value per well of $49.6 million for a total value of that asset based on PDP, proven developed producing only, of $397.4 million. The Washakie County in Wyoming in the Bighorn Basin has a total of 10 wells being drilled. The barrels of oil per well are roughly 212,000, while the MCF of natural gas is 4.5 million per well for a total PDP value per well of 44.3 million and a total asset value of $443 million based on the PDP. When you factor in the PUD, the proven undeveloped multiple, we get our total of just over $1 billion on this fund on a raise of 200 million, generating significant value for our investor partners. It's attractive for the company, a win-win across the board on the economics. For the investor partners, because that's what you care about, what does this do for you? Number one, oil and gas investments provide a 100% write-off against either W-2 or capital gains. You can use this to offset a significant amount of taxes, which immediately de-risks the investment for you. You can reduce your tax burden on a $200,000 investment by up to $60,000. The monthly passive income, we target anywhere between 14 and 21% annualized. Unlike real estate funds or multifamily syndications, you don't have to wait quarterly to receive your distributions. We pay monthly based on the sale of oil and natural gas. As we saw on the timeline slide a little bit earlier, we're looking at starting those distributions towards the end of March, early April. And our previous fund has an annualized average of 17%. We have a track record of achieving this type of return for our investors. The total multiple on exit at the end of the day, at the end of the fund, what has this done for you within a 3 to 5 year period? We want to turn a $200,000 unit into $680,000 or $1 million unit into $3.4 million. Looking a little bit more in detail on the tax reduction. So on a $200,000 investment with a deduction factor in year one of 75 to 85%, that would mean a 150% deduction against W-2 or adjusted gross income. At a marginal tax rate of 40%, that would generate an estimated tax savings of $60,000, meaning that now you're only risking $140,000 on that $200,000 investment, and you start receiving monthly passive income in Q1, Q2 of 2023, working to de-risk it even further, an initial divestiture in 18 to 24 months to return the remaining amount of your principal, not even factoring in the tax savings up front, and a total exit within 3 to 5 years for a 3.4x return. I don't know of any other investment that provides that unique combination of value for its investors. The monthly passive income, the MPI, you'll see a lot of those acronyms throughout this deck. Every dollar out of the ground first pays the royalty owner mineral rights for the landowners. Then it pays the lease operating expenses. And then of the profit, 80% goes to our investors and 20% goes to King. After return of principal has been achieved, that's when our big interest really is there and our incentive. It switches from an 80-20 split to a 60-40 split after investors have been paid back. A multiple on exit scenario, just looking at a hypothetical, if we were able to sell the fund tomorrow for that billion and change, there's 1,000 units that would be entitled to a pro rata share of just over a little bit of $1 million. As we look at the 80-20 split, that would require $250,000 of that number to pay the $200,000 back to the investor. The remaining amount would then be a little bit over $800,000. On the 60-40 split, $480,000 and some change would go to the investor for a total of $680,000 returned on that $200,000 unit. And that's where we get to that forecasted gross multiple of 3.4x. Being that most of our investors come from a real estate environment, we love looking at comps. We think it gives not only the team confidence that what we're doing, not only from our own track record has been achieved, but also is being achieved by other companies in the market right now, and that there are plenty of buyers for these type of assets. So a most recent and similar comp that we've seen in the Permian Basin in October of 2022, Northern Oil bought a 36.7% working interest in the Mascot project in Midland County for $330 million in cash, putting that project valuation right around that $1 billion mark for a partial divestiture, which is what we're trying to do within 18 to 24 months. So it's a perfect comp for the exact strategy that we're deploying for this fund. Another one that just kind of shows the level of interest that not only other oil companies have, but also private equity funds. Over just the last 12 months, there have been 16 deals worth $12 billion in the Permian Basin, in other basins of focus where we're involved. Private equity, major oil and gas producers are interested in buying up proven, developed, producing fields where they have more ability to drill out, get safe income, tax advantages. They're interested for the same reasons that you are interested right now. Finally, let's look a little bit into the track record and team of the company. When our owner and founder, Jay Young, departed from the initial 15 plus years of doing business the old way, where you're drilling a single wellbore assignment, an individual well, and an investor is investing purely for the tax benefit and the monthly distributions from the profits. He looked at that and said, okay, this is awesome. This is good, but how do we make it better? And he started looking at what other funds were doing, specifically multifamily syndications. They had the exit, they had the asset. And so he said, okay, let's include the asset of the leases into the fund, give them pro rata ownership in the exit in the long term of the deal, so that every well that we're drilling is developing value for not only us as the company, but also the investors. So at the end of 2015, they raised a small pilot program just to test the waters. $4.5 million raised, divested within 18 months for $13.5 million, a 3x return in 18 months. And the light bulb moment where he thought we could do this had now been verified. So at the end of 2018, they said, all right, let's run up another one. Let's make this one a little bit bigger. And every single investor that I've talked to always asks the same question: what's the worst case scenario? And I cannot think of a worst case scenario or something that could derail an oil and gas fund more than the pandemic that sent oil to negative a barrel and essentially wiped out global demand overnight when the lockdowns occurred. So between 2018 and 2020, not only were there regulatory obstacles, there were low price points across the board. It just wasn't a hot market for oil and gas. But then the pandemic is really what happened. So that's really what everyone wants to know is, what does a company do when it's the worst case scenario? And what I love about Jay, what I love about the leadership team at King is they said, okay, we could just close this fund up. We could write off the losses and, just bad luck for everyone. We're invested personally, bad luck for us, bad luck for investors. But what they said is there's an opportunity here. We can grandfather those partners and assets into a larger fund. We can scoop up more additional assets while prices are next to nothing, and we can accelerate the timeline to drive an ROI. So 18% ROI as of 11/22. We're on track for a 3.5x total multiple on their investment. We've beaten the MPI forecast 6 months in a row, and we're on track to put an initial divestiture in that fund to have return of principal occur sometime towards the end of 2023, which, given where it started, I think it's a tremendous story for not only the ability for the leadership team to pivot and drive value as quickly as possible, but also for the ethics to stay with those investors, stand behind them, and make sure that they're doing the right thing for investors at every turn. And then when we look at the current fund that we're raising, a 3.4x forecasted multiple, a 3 to 5 year lifespan of the fund, and a return of capital forecasted within 24 months, the track record gets better and better every single month as we continue to drill more successful wells, continue to prove our industry expertise, and validate the experience of the leadership team. When we look a little bit closer at the divestiture, this is just going to give you some interesting data points like the date it was spudded, where it was specifically, the well date, the amount of income generated prior to the divestiture, the total amount of money received from the proceeds of the sale, the fund's benefits, as well as the depth of the wells. This will again be provided with you. I don't want to spend too much time diving into a bunch of numbers. Same thing on the previous fund. What's awesome here is that you can actually see exactly how much has been generated, the total cash on cash return over the life of the fund, as well as an initial divestiture of a small asset that we had recently. So exciting stuff happening with the last fund. Like I said, return of principal should occur sometime in late 2023. And by the end of 2024, have a 3.5x multiple for investors. Experience is not enough. Expertise is everything. When you look at Jay Young, the founder and CEO, he's a fourth generation oil man, lives and breathes as well as bleeds oil and gas. His family joked as he was growing up, you either go into the oil business or you marry into the oil business. And that is just what he cares about: drilling successful wells, driving value for investor partners. He wrote the book, The Upside of Oil and Gas Investing, which if anyone has interest, please get with Charles and Lena. We're more than happy to send you a copy of that book. And it's just really great to learn how he had the idea to integrate a real estate multifamily model into the oil and gas space to disrupt the way that oil and gas companies are driving these investment funds. Peter Snell and Eric Rice are driving the business growth and business operations component of the business. Michael Tanner, in conjunction with John Malden, as well as Rex Gifford, handle the oil and gas economics. They work close in hand with Graham Patterson, our CFO, to make sure that we're providing accurate and conservative estimates and forecasts. Garrett Stacy works alongside Paul Jerome to ensure that we're maximizing production, geology and asset prospecting are done accurately, and everything relies on execution from Chandler Knox in the field, our COO, who is in charge of drilling, controlling the angle of the drill bit, fracking, how many stages are we going to do. Everything that is field operations is where Chandler Knox is going to succeed, has personal experience working with the Hunt family, along with a multitude of other oil and gas industry companies. He's exactly the guy that you want controlling the drill bit. So what is the deadline? What's the incentive to act quickly on a deal like this? Number one, December 16th is your deadline for the maximum tax advantage on your 2022 return and K1 that we'll deliver to you next year. As long as you get funds in by the end of December, you will get a massive tax advantage, somewhere north of 70% in year one. The entire amount is still going to be deducted over the lifespan of the investment. Over the following 4 years, you'll get the remaining portion, whether that's 20 or 30%, depending on when you get your funds in and what that deduction factor ends up being, somewhere between 70 to 85%. But all you have to do at this point is review the PPM, decide how many units, review the subscription agreement, execute the DocuSign, and wire the funds in, and you are good to go. If you do have interest in the fund, make sure that you reach out to Charles or Lena. Either of them can connect you with myself or one of our other team members assisting the Strategic Passive Income Partnership. And then some of the most common questions that Charles asked me to cover. Number one, what does a current administration and the policies that we've seen have an effect on a fund like this? Number one, strangling the ability to produce and drill only accelerates the price point. They can dump strategic petroleum reserves. They can drain those to a 40-year low, and that will subdue prices for a while. But at some point, they have to start buying oil back. And that's just buying even more off of the streets to put back into the reserves when we already don't have enough supply for the demand levels that we're experiencing right now that are increasing year over year. So that type of political leadership in place actually is good for prices. Another common question is what happens if oil goes down? Remember, we're using $80 price points for oil and $6 price point for natural gas. If this went down to 60 and 5, you're still making money. It's not 3.4x, but it's still a profitable investment with a tremendous tax advantage and monthly passive income to offset inflation. So a lot of those are the most common questions. If you do have other questions, please reach out to Charles and Lena. They'll be able to connect you with myself. We can schedule a Q&A session, or just get on the phone and walk through the deck in a little bit more detail or cover the PPM, whatever you guys need to do. But I thank you for your attention and viewing this deck. We look forward to adding many of you as investor partners. The updates will be provided by Charles and Lena in conjunction with us at King Operating. And we're just really excited about the opportunity that we have right now at this point in time. So thank you and have a great night.